In the marble halls of the National Bank of Poland, beneath chandeliers that cast long shadows across polished floors, Governor Adam Glapiński signs another gold purchase order. The pen scratches against paper in the quiet chamber. Outside, Warsaw's winter air carries the weight of history, but inside this room, something else weighs heavier. The decision he makes today isn't about Poland alone. It's part of a pattern that spans continents, crosses decades, and connects central bankers who will never meet each other in rooms they will never share. As his signature dries on the document authorizing another 90 tons of gold purchases, he doesn't realize he's participating in the largest coordinated shift in monetary behavior since the end of the gold standard 50 years ago. What he doesn't know is that similar decisions are quietly emerging across multiple regions, not due to a secret deadline, but due to shared economic incentives central banks often face at the same time. They're all buying gold, not hundreds of tons, not even thousands, over 3,000 tons in just 3 years. And while the timing appears aligned, analysts generally describe it as an outcome of parallel risk management strategies rather than any hidden or coordinated timetable. The paradox should terrify you, but it won't, because the numbers are too large to feel real. In 2024, central banks purchased over 1,000 metric tons of gold for the third consecutive year. That's not diversification. That's not routine reserve management. That's preparation. Preparation in the sense of building long-term financial resilience. Not preparation for any specific predicted crisis, but preparation for what? The official statements speak of financial stability and portfolio balance. The academic papers discuss reserve optimization and currency hedge ratios. The press releases mention geopolitical uncertainty and monetary prudence. What they don't mention is the mathematical impossibility hiding beneath these calm explanations. Because when you trace the buying patterns, when you map the timeline, when you follow the acceleration curve, you discover something that changes everything. They're not just buying gold, they're buying time. And time in the world of central banking is the one commodity that can't be printed, can't be borrowed, and can't be negotiated. It can only be buffered with assets that central banks historically view as durable across long periods. The story begins not in 2024, not in 2022 when the buying surge started, but in 1971, in a place that no longer exists, Camp David, Maryland, on a summer afternoon when President Richard Nixon made the decision that would reshape everything you think you know about money. The room was air-conditioned against the August heat, but the tension was suffocating. Nixon's advisors had laid out the mathematics with brutal clarity. The United States was running out of gold. Foreign governments were demanding payment in gold for their dollar reserves, and the vault at Fort Knox couldn't honor those demands much longer. The choice was simple and catastrophic. Either admit that the dollar couldn't be backed by gold anymore, or watch America's gold reserves drain away completely within months. Nixon chose the first option. On August 15, 1971, he announced that the United States would no longer convert dollars to gold at a fixed rate. He called it temporary. 54 years later, it's still temporary. What Nixon didn't realize, what his advisors couldn't have predicted, was that this decision didn't eliminate the world's need for monetary anchor. It just postponed the reckoning, because without a fixed convertibility mechanism, global finance adapted into a confidence-based system, one that economists still study and debate today. For 3 decades, the experiment seemed to work. The dollar remained the world's reserve currency not because it was backed by gold, but because America's economy was strong enough, its military powerful enough, and its institutions stable enough to guarantee those promises. Central banks held dollars because everyone else held dollars. Countries traded in dollars because everyone else traded in dollars. The system worked through momentum, through habit, through the simple mathematical fact that changing would be more expensive than staying the same. But experiments, even successful ones, eventually reached their limits. And by the early 2000s, the mathematical foundations of the post-1971 system were beginning to crack, not dramatically, not visibly, but steadily, quietly, in ways that only central bankers with access to the deepest financial data could see. The cracks appeared first in the debt ratios, then in the currency volatility patterns, then in the trade imbalance equations that should have corrected themselves but didn't. By 2008, when the financial crisis revealed how fragile the entire system had become, central banks around the world made a decision that would define the next 2 decades. They would start buying gold again, not as a return to the gold standard, not as a rejection of the dollar system, but as insurance. Insurance in the sense of diversification, a standard practice in reserve management when navigating long-term uncertainties. The buying started slowly, quietly, almost apologetically. A few tons here, a dozen tons there. Central banks spoke of portfolio diversification and prudent reserve management. They emphasized that gold purchases didn't represent a lack of confidence in existing monetary arrangements. But the mathematics told a different story. Because when you compound those small, quiet purchases over 15 years, when you track the acceleration patterns, when you map the geographic distribution of buying, you discover that central banks weren't just diversifying, they were preparing for a range of possible future scenarios, not a predictable or inevitable breakdown, and the preparation was accelerating. By 2022, annual purchases had crossed the psychological threshold of 1,000 tons. By 2024, they were buying at rates not seen since the immediate aftermath of World War II. The quiet diversification had become a quiet revolution. But revolutions, even quiet ones, have leaders. And in the world of central banking gold purchases, the leaders weren't the countries you might expect. The largest buyers weren't the traditional gold powers like Germany or the United States. They were emerging economies, countries whose central banks had watched the 2008 financial crisis, watched the European debt crisis, watched the currency wars of the 2010s, and drawn their own conclusions about the stability of the current system. Poland led the way, increasing its gold reserves from negligible levels to over 400 tons in just a few years. China accumulated gold steadily, month after month, never announcing targets but never stopping purchases. Russia built reserves that would later prove crucial when sanctions froze its dollar assets. India, Brazil, Turkey, Kazakhstan, countries that had learned to distrust systems they couldn't control, accumulating the one asset that no government could freeze, no institution could manipulate, no crisis could eliminate. Or more precisely, the one asset widely viewed as historically resilient and difficult to interfere with. What these central banks understood, what their careful statements never quite articulated, was that the mathematics of the current system were becoming untenable, not next year, not necessarily in 5 years, but eventually, inevitably, according to the same mathematical principles that govern all complex systems under stress. Economists describe these pressures not as predictions of collapse, but as long-term structural challenges that policymakers continually work to address. The global debt-to-GDP ratios that should have stabilized were still climbing. The currency imbalances that should have corrected were still widening. The demographic trends that should have supported growth were still declining. And most critically, the political consensus that had supported the post-1971 system for 5 decades was fragmenting not just in America, but globally. As populations grew skeptical of institutions they increasingly saw as serving interests that weren't their own. The central bankers buying gold weren't conspiracy theorists. They were mathematicians and policymakers evaluating long-term risks rather than forecasting any predetermined outcome. And the mathematics were pointing toward a conclusion that none of them wanted to say aloud. The 50-year experiment in pure fiat currency was approaching its natural limits, not in the sense of imminent failure, but in the sense that economic systems periodically evolve and require adaptation. Not because anyone wanted it to end, not because anyone was actively undermining it, but because all systems, even successful ones, eventually exhaust their mathematical foundations. The gold purchases weren't a vote of no confidence in the current system. They were a recognition that all systems are temporary and that the wise prepare for transitions even when they can't predict exactly when those transitions will occur. The turning point came not through revolution but through mathematics. By 2008, when the financial crisis revealed the fragility of interconnected systems, central banks faced a calculation that transcended ideology. The numbers showed stress fractures in the architecture that had supported global trade for nearly 4 decades. But these weren't abstract mathematical problems. They were human problems, wearing the masks of statistics. In the quiet aftermath of that crisis, as governments borrowed trillions to prevent systemic collapse, a different kind of conversation began in central banking circles, not the public conversations captured in meeting minutes or press releases. The private conversations that happen in margins of international conferences, in secure phone calls between governors who understood that their decisions shaped the lives of billions. These conversations weren't about conspiracy or coordination. They were about insurance, about the mathematical probability that systems under increasing stress eventually reach their breaking points. In other words, standard internal risk assessment discussions that all central banks routinely engage in. About the historical precedent that all monetary arrangements, no matter how successful, eventually exhaust their structural foundations. What they discovered, as they analyzed the data from 2008 and its aftermath, was that the crisis hadn't been an anomaly. It had been a preview not of guaranteed collapse, but of vulnerabilities that policymakers would need to monitor and address over time. The mathematical tensions that caused the crisis hadn't disappeared. They had been papered over with unprecedented monetary intervention, with quantitative easing programs that created money on a scale never before attempted in peacetime. The intervention had worked, in the sense that it prevented immediate collapse. but it had also accelerated the underlying dynamics that made the system unstable in the first place. The debt levels that should have decreased after the crisis continued climbing. The currency imbalances that should have corrected themselves became more pronounced. The demographic trends that should have supported economic growth in developed nations continued deteriorating. Most critically, the political consensus that had supported the post-1971 system began fragmenting as populations grew skeptical of institutions that seemed to serve interests they couldn't identify or understand. Central bankers trained in mathematics and history began drawing conclusions that they couldn't articulate in public speeches. The system that had emerged from Nixon's decision in 1971 had been an experiment in whether confidence alone could replace tangible backing for global currency. For 3 decades, the experiment had succeeded brilliantly, but experiments, even successful ones, eventually encounter conditions that test their limits. And by 2010, those conditions were becoming visible to anyone with access to the right data. This is where the story accelerates, because what happened next wasn't coordinated or planned. It was emergent, arising from identical conclusions reached independently by central bankers who understood that their primary responsibility was protecting their nations from monetary instability, regardless of its source. The buying began quietly, almost apologetically. Central banks spoke of portfolio diversification, of prudent reserve management, of reducing concentration risk in dollar-denominated assets. These weren't lies, they were accurate descriptions of the immediate motivations, but they obscured the deeper calculation driving the decisions. Because when you compound modest gold purchases across dozens of central banks over more than a decade, when you map the acceleration patterns, when you track the geographic distribution of buying, you discover something that changes how you see the entire global monetary system. Oh, they weren't just buying gold, they were buying optionality, the option to participate in whatever monetary system emerged if the current one reached its mathematical limits, not because such a shift is certain, but because preparing for a range of long-term possibilities is standard central bank prudence. Because history taught them that monetary systems, like all complex systems, don't decline gradually. They function normally until they don't. They maintain stability until the moment they can't. And when that moment arrives, it arrives quickly, leaving little time for preparation. This is not a forecast. It's a reflection of how central banks model resilience. The story ends where it began, in quiet rooms where decisions echo across centuries. The gold purchases aren't signals or warnings. They're mathematics made manifest, the accumulated weight of 50 years of monetary experiment finally expressing itself in the most ancient form of insurance humanity has ever known. The central bankers signing these orders understand something that transcends politics or ideology. Systems evolve according to their own internal logic, and when that logic reaches its natural conclusion, preparation becomes the only rational response. Not preparation for collapse, but preparation for adaptation, the same principle that has guided monetary policy for generations. The real reason no one mentions isn't conspiracy or coordination. It's simply that some truths are too large to speak aloud. If this changed how you see the patterns that shape our world, there are other stories waiting, other systems whose quiet evolution deserves your attention.